Good morning. We will pay attention to the debt-equity ratio today. The debt-equity ratio provides a comparison between the firm's own capital and the borrowed capital that they obtain from financial institutions. So the own capital is the capital that was provided by the shareholders because they bought shares in the company. The borrowed capital is loans or mortgage loans that was obtained from financial institutions. The ratio indicates to which extent the firm's assets and operations are financed through the use of equity or by long-term loan. So it means that we want to determine all the money that we need in the business for our assets and to keep the business running. How much of the money that we need did we obtain out of the capital that the owners provided when they bought shares, or what we borrowed from a financial institution? A firm will be exposed to greater degree of risk and gearing when the ratio of debt financing to equity is high. That means if your loans are high in comparison with the money that the owners provided, then you will have a greater degree of risk because the business will have to pay back the loans and the interest even if they don't make a profit. Gearing explains how the firms finance its operations, even through outside lenders or through the shareholders. So do they use loans to do everything in the business, or do they use the equity provided by the shareholders? Companies with a high gearing have more long-term liabilities than shareholders' equity. So that means that their long-term non-current liabilities is more than the capital and the retained income that consists of shareholders' equity. They are exposed to more risks because they will have to pay the installment on the loan and the interest on the loan even when profits are low. So it means it's risky for the business because they've got this extra money that they have to pay. If they don't make a profit, it can result in cash flow problems. Companies with low gearing means that the shareholders' equity is more than the loans that was obtained. This is less risky for the company because they don't have to pay installments and they don't have to pay interest on loans when profits decline. So they don't have this extra money that must be paid out if they don't make enough money. Gearing is regarded as favorable when funds are borrowed at a relatively low interest rate, but it results in good returns. So if we borrow money at, say, for instance, 10% interest rate, but the profits that we make increase to 20% as a result of this loan, then we have a favorable gearing. Gearing is unfavorable when funds are borrowed at a relatively high interest rate when the profits are low. So that means it's unfavorable for the business if they borrow more money and they have to pay a high interest rate, but the loans that they obtain didn't result in extra profits for the business. We have the balance sheet of Alex Limited here, and we're going to use this now to calculate the debt-equity ratio. To calculate debt-equity ratio, we have to take our non-current liabilities and divide it by the shareholders' equity. My non-current liabilities are the long-term liabilities that I take more than a year to pay back in the future. So that is 1980 for 2015. Shareholders' equity consists of all the money that belongs to the owners. So that means it's the total shareholders' equity that consists of the share capital and the retained income. And for 2015, it's 4123. So if we do this calculation, we see that the debt-equity ratio in 2014 was 0.27 to 1. That means the shareholders' equity is much higher than the long-term liabilities. So for every R1 equity in the business that the owners provided as capital, they borrowed 27 cents from financial institutions to obtain loans. In 2015, it is 0.48 to 1, so that means they owe 48 cents for each R1 that the shareholders provided. If we look at these two figures, we can see that in the previous year we owed 27 cents for a rand. Now we owe 48 cents for a rand. That means the company was more dependent on external financing in 2015, because for every R1 own capital provided by the owners, the shareholders, the company borrowed 48 cents from financial institutions. The firm had a higher gearing in 2015 because the risk is higher if the loans increase, because you've got more borrowed capital and interest that you have to pay, even if the profits are low. The firm had lower gearing in 2014 because the risk was lower when own money is used and not borrowed money. The share capital is not paid back, and if the profit is low, they don't have to pay out any dividends. You have to compare these figures with the firm's policy to see if it's satisfactory. You should also compare it with competitors' figures to determine if you have more or less the same ratio than the competitors. If the ratio is not satisfactory, the following measures could be implemented. Reduce dependency on long-term debts, because the debt and interest must be paid back when profits reduce. Increase own capital by issuing more shares, because capital is not paid back to shareholders, and if the profits are low, they don't have to pay dividends. What did we learn? The company must compare their own capital provided by the shareholders with the borrowed capital provided by financial institutions as long-term loans to determine whether the risk is high gearing, because you owe a lot of money and you have to pay back the loan and the interest. When the risk is low gearing, it means that the own capital is used more in the business than borrowed capital, and you don't have to pay the own capital back. Before the company borrows more money, the company must calculate the debt-equity ratio to determine if it increased profits as a result of the loan. So if you borrow money at a high interest rate, the profits that you make as a result of this additional money that you received out of the loan should increase, and the increase should be more than the interest that you pay on the loan. If you get a loan to expand the business, it means that your profit must be higher than that extra interest that will be paid.